All right. Good evening, everyone. I hope you are here. Auntie Oli, can you hear me? Auntie Oli, can you hear me?
Yes, please.
Okay. I hope you are doing well.
Yes, so.
Okay. Today we are coming to finish 3 issues at once. One question on each of them. Then we are done. So, the first one is we say changes in group structure. You see, what we know, okay, most of us we haven't done FR, but what we know in FR is that whenever the parent or whenever the investor is going to acquire the investee, or whenever the companies want to acquire another company, they will just go and buy more than 50% and gain control at once. So they will just go and buy more than 50% and gain control at once. But in most cases, what will happen is that the entity can just go there and buy 20%. Maybe they can go there and buy 20% on January 2022. So maybe 2 years time, which would be January 2024, they can go and buy additional 40%. So you can see that the way of getting control or the way of gaining control in this case is different from you just going to buy more than 50% at once. So mostly what happens is that the entity can buy small portion and you come and buy another portion, and if you add the two, you now have the 50%. Control is gained when the entity has more than 30%, more than 50% of the shareholding of another company. Basically, that is what we say control is gained. We have so many ways of getting control, but for the purpose of what we are coming to learn, when you have 50% of the shareholdings in a particular company, we can say that you have control over that particular company. Even though you can have 30%, but you still have control. But for our studies, if you have more than 50%, then you have control over that particular company. But this 50% or more than 50% can be, people can decide to acquire it in so many ways. The person can acquire the first 5%, the first 10%, the next one they will go and acquire 20%, then the next one they will acquire 30%. So in all, they are going to have 60%. This 60% was not bought at once. It wasn't bought at the same date. But they have 10% first, which is lower than 20% and 50%. So if you have a shareholding which is lower than 20%, you are going to account for this as a financial asset in accordance with financial instruments. So if you have shareholding less than 20%, you are going to account for that as financial assets in accordance with financial instruments. But if you have a shareholding which is more than 20% but less than 50%, then you are going to account for this using equity method or equity accounting method, which you are going to classify the investment as investment in associates, more than 20%, but less than what? 50%. But if you have from 50% and above, then you are going to consolidate this particular investee. You will say that the company has control, and the person that you are buying the 50% in or more than 50% in will now be seen as subsidiary. So you can now consolidate the account together with your own. So in this case, we are going to assume that 50% is the benchmark. 50% is the benchmark. So if you're talking about step acquisition, we are talking about control being gained in stages. Control being gained in stages. The time that you are going to buy the shares, you didn't buy more than 50% at once, but you bought it in stages. So the first one was 10%, the second one was 20%, and the last one was 30%. So the time that you bought the 30%, that was the time that you have control. So for step acquisition, where we have from non-control to control, if you are talking about from non-control to control, 10% doesn't give control. You bought additional 20%, still is 30%. You don't have control. So you are from non-control, you don't have control. By the time that you bought 30%, you now have control. So this is what we call from non-control to control. If you are from non-control to control, consolidation will start from the date that you gain control over that particular subsidiary. So if the first one was 2021, the second one was 2022, and this was 2024, control was gained on 2024. If that is January, you start consolidating from the date that you have control, which will be 2024. That is for non-control to control. So you are going to consolidate from the day that you have gained control, and everything about consolidation will start from the date that your total shareholding is more than 50% or is equal to 50%. Calculation of goodwill, anything will start from that particular date. Anything about consolidation will start from that date. We also have another way where the first time you bought the shares, you bought 60%, but you decide to buy additional 10%. So if you are trying to buy the additional 10%, what we say is that we are saying that you are just buying part of the NCI. So if you are buying 60%, it means that NCI will be having 40%. So if you decide to buy 10% now, it means that you are trying to buy the 10% of the NCI. You are trying to buy the 10% of the NCI. So NCI will now be having 30%. But the question now is, what portion of the NCI are you buying? Assuming the time that you are buying the NCI, they have a fair value of 30,000. This fair value of 30,000 is equivalent to 40%. So if you're now buying 10%, it means that you are buying the 10% out of 40. So for you to know the portion that you are buying, you calculate 10 over 40 times the NCI value at the date that you are buying this particular one, which is 30,000. So if you have this, assuming the answer is maybe 7,500 or something. If the answer is 7,500 and you are paying 8,000, it means that you are paying more than you should pay. You are paying more than you should pay. So NCI will have 8,000, but you are paying what? NCI will be giving you 7,500, but you will now pay them 8,000. You are paying more than you should pay. What happened is that the 500, you should have seen it as an expense. But since it's relating to shares, we don't send it as an expense. We take the excess to other component of equity. Other component of equity. So the excess, which is you are buying the shares at a premium. You are buying the NCI at a premium. So the double entry that you do for this one is debit cash. I say debit cash. So you debit NCI. You debit NCI with 7,500. NCI will reduce by 7,500. You debit your other component of equity with 500. Then you credit your cash. You credit your cash with that particular 8,000. So if you are moving from control to control, from control to control is a situation where you already have control, you already have more than 50%, but you decide to buy part of the NCI shares again. If that happens, what you do is that you ask yourself, what is a portion of the NCI that I'm buying? So you have to determine the value of the NCI as at the day that you are buying the additional shares. So you find your percentage over their percentage multiplied by the shares that you have. So if it is 40%, it will be 10 over 40 times the NCI value as at the day that you are buying the additional 10%. If you are doing statement of profit or loss, assuming you are buying the NCI on July 1, but the reporting period is January to December, if you are coming to share the profit among them, the first 6 months, which is from January to June, NCI share will be 40%. But from July to December, NCI share will now reduce to 30% because you have acquired additional 10%. So if you are doing statement of profit or loss that you want to share the profit for the year, the time that you didn't acquire the 10%, NCI will be having 40%. But from the time that you acquire them, their share will now be what? 30%. That is if you are doing statement of profit or loss. But if you are doing statement of financial position, which is always the question that will come relating to step acquisition, if you are doing that, you ask yourself, when did I acquire the additional shares in the NCI? So maybe from January to June, they have 40%. So you now split the profit into two. First 6 months, last 6 months. NCI will have 40% of the first 6 months. The last 6 months, they will have 30%. That is how you are going to share the NCI share of the post-acquisition profits. But let's come to, for control to control, there is no big deal. There. Let's come to where we have from non-control to control. Assuming you are having 20% first, you are accounting for this as investment in associates. So you bought this at 10,000. Maybe you are accounting for this as investment in associates. So you have increased, you have a profit of 5,000. You have a profit of 5,000. So you have increased this. So on July 1, you acquire additional 40%, now giving you a control. You will now have 60%. But they will give you, the question will give you the fair value of your old investment. So they can say the fair value of the old investment now is 25,000. The fair value of the old investment now is 25,000. It means that your investment has increased by 10,000. What we do is that we assume that we sold the original investment and buy it back. So we assume that we sold it and bought it back. So we are going to sell the old investment at 25,000 and buy it back at 25,000. So if you sold it at 25,000, which is 15,000, you are making a gain of what? 10,000. So if you are doing step acquisition, which is from non-control to control, they will give you the fair value of your initial investment. Ask yourself whether there is a gain. If there is a gain, send it straight forward to return earnings. If you are doing statement of financial position, send it straight to return earnings. But if you are doing statement of profit or loss, you have to ask yourself, which part of this gain relate to this current year that I'm preparing the statement of profit or loss? So you determine the current profits or the current gain relating to the 10,000 and you send it to profit or loss. So assuming this was 15,000 at the beginning of the year, and now it is 25,000 at the middle of the year. It means that the 10,000 relate to the accounting period under consideration. So we take the 10,000 to profit or loss as a gain. But if you're not doing profit or loss, which is mostly you are not going to see in the exams, you will always see statement of financial position. Look at the gain. Look at the initial value of your investment, 20%. What is the fair value now? You find the difference and send the gain to return earnings. And your 20% will now be valued at the new value, which is 25,000. So if you are paying 65,000 for the 40%, your total consideration will now be 90,000. not 10,000 plus 65. No, because your new value now is 25,000 for 20% plus the additional 65,000 that you are paying for the 40%. That will be your total consideration. That will be what you are going to use for calculation of goodwill. All right. Let's pick some examples, then we see what we can do. Let's see the example 1. Example 1. Please, who is reading for us? Example 1. Fast, let's move on. Hey, Arimeya, are you also part of this class? I've seen you for a long time. Senior, Arimeya.
Yes, sir. Yes, sir.
Hey, you are wrong.
Yes, sir.
Hey, the last time I heard from you,
I was thinking I would not be able to write the corporate report, but I've just taken a decision.
Oh, at the last hour.
Aye.
Okay, and you go and try.
Inshallah.
There's no harm in trying, because I'll be seeing you in advanced tax class.
Yes, advanced tax and audit.
The thing is, whether you like it or not, you pay for the
yes.
So just go and write. Just go and write.
Sir.
So
okay.
Just go and
after
write.
The class, I'll call you, sir.
No problem. Okay.
No
problem. So let's take the example 1, then we pick a question. We are done with step acquisition. We move on to disposal. Auntie Olivia, read the example 1 for us so that we move on.
A acquired 10% of the equity share of B for 18,000 Ghana cedis on January 1, 2016, and classified the investment as fair value through other comprehensive income in accordance with IFRS 9. At 31st December 2016, the fair value of the 10% investment in B was 24,000 Ghana cedis, and this was reflected in A statement of financial position, resulting in a gain of 6,000 Ghana cedis being recorded in other components of equity. On June 1, 2017, A acquires a further 50% of B's equity shares for 160,000 Ghana cedis. At this date, the fair value of the original 10% investment was 28,000 Ghana cedis. The fair value of the net assets of B was 200,000 Ghana cedis, and the fair value of the non-controlling interest, now that B has become a subsidiary, was 100,000. It is group policy to measure NCI at fair value at the date of acquisition. Required. Explain how the above transaction will be accounted for on June 1, 2017, the day that A achieved control of B, and calculate goodwill arising on the acquisition.
Okay. So that is a question before us. We should explain how the above transaction will be accounted for on 1st June 2017, the date that A achieved control of B, and calculate goodwill arising on the acquisition. How are we going to account for this? How are we going to account for it? Did A obtain control over B on the June 2017? Did A obtain control over B on the day that they are asking us to explain how this will be accounted for? Okay. A was previously having 10% of the shareholdings of B, but on June 17, they have bought additional what? 50%, and this is now giving them 60%. So on this particular day, they have gained control over B. They have gained control over B. But the question now is, what is the fair value of our initial investment, the 10%? What is the fair value as at the day that we have now gained control? What is the fair value? What is the fair value?
28,000.
What was the value before this acquisition? What was the value before?
24,000.
24,000. But now it is what? 28,000.
28,000.
What is happening?
There is an increase.
There is an increase of how much?
4,000.
4,000. So if you are preparing statement of profit or loss for this year, we show increase or we show a fair value gain of 4,000 in the statement of profit or loss. But if you are not doing that, what we are going to do is that the first 4,000, the first 6,000 was recorded in other component of what? Equity. So since this is in the other component of equity, we are coming to reclassify the investment. So since we are coming to reclassify the investment, we also reclassify the gain. So we will take the gain, which is the 6,000, which is in the other component of equity. We are going to take it from that place and transfer it to retained earnings together with this particular year dividend, this particular year gain, which is 4,000. So we are going to transfer the gain from the other component of equity, 6,000, to retained earnings because we are now reclassifying the investments. We are not going to have any investment through other comprehensive income again. We assume that it has been disposed. So if it has been disposed, all the gains relating to it must be reclassified to retained earnings. And this year's gain of 4,000 will also be sent to retained earnings. So in all, we are sending 10,000 to retained earnings, which is the 28,000 minus the initial 18,000. All right. But what will happen now is that A has gained control over B on this particular date. So A must consolidate what? B. They have to calculate if there's any goodwill from the acquisition, and if there is any share, any post-acquisition profit, they will share it among the NCI and then the parents. So the parent will now be having 60% and the NCI will now be having 40%. So we have to determine the new consideration now. The parent has to determine the purchase consideration. So the parent has to determine the purchase consideration to find a goodwill. So the first one is the fair value of the initial investment. Fair value of the initial investment. So the fair value of the initial investment now is how much? Fair value now is how much? 28,000. Okay. The fair value of the additional 50%. How much are they paying?
20, yeah.
This year is 24.
That's 24.
It's 28. As at the date that we are gaining control, we now fair value it to the current fair value, 28,000. At this date, the fair value of the original 10% investment was 28,000. So you assume that you have sold it and rebought it. So if you sold it, it will be 28,000, then you repurchase it together with your 50%. You are going to buy the 10% at 28,000 and buy the 58% as 160,000. So the 50% you are paying 160,000. So in this case, your total consideration will be 188,000. So the question now is, what is the fair value of the net assets of the B? What is the fair value of the net assets?
$200,000.
This 200,000 relate to the total entity, which is owned by the parent and then the NCI. So what is the NCI portion of the 200,000?
40. percent of 18,800.
No, it is the policy of the group to measure non-controlling interest at fair value at the date of acquisition. So if you are doing that, it means that you are using proportionate method. So you have to now ask yourself, what is the fair value of the non-controlling interest in the question? What is the value of the
100,000.
100,000?
Yeah.
Okay. If the total value is 200,000, NCI is 100,000, how much will be the parent own? What portion is the parent buying? Parent will also be having 100. So what will be the goodwill from this transaction? 88,000. All right. You can also decide to add the non-controlling interest to 188 and take all the 200,000. Anyhow you want to do it. All right. So the 200,000 is for total company. The NCI will take their portion, then the parent will also take their portion. So that's the parent is paying 188,000 for 100,000. They are paying 88,000 in excess, and that technically refers to maybe the location of the company that they are buying, the kind of relationship that they have with the customer. They are seeing that as a way of them making enough sales or having a gain. So they are paying for those things, which is a good deal. All right. Let's go to where we have a control to control. Control to control. Let's look at example 3. Then we pick one tutorial question. We solve. We say bye-bye to step acquisition. Okay. Do you have any issue with the goodwill calculation and everything? No. Let's move on. Okay. Let's take the example 3. Auntie Olivia.
J has owned 80% of M for many years. It has just acquired a further 10% of M's share for 50 Ghana cedis. At acquisition, the fair value of the NCI in M was 100,000. The net assets of M at acquisition were 300,000 Ghana cedis and are 400,000 at the date of acquisition of the additional shares. It is group policy to value the NCI at fair value at the date of acquisition. Required. Calculate the difference that will be taken to other components of equity on the acquisition of the additional shares in M. Clearly state whether this will increase or decrease the consolidated reserves of G.
Okay. So what are we going to do? We need to know the fair value of the NCI as at the day that the parent is acquiring the 10%, isn't it? Okay. They are saying that the NCI at acquisition is how much? NCI at acquisition is how much? 100,000. Okay. So NCI at acquisition, what they are talking about is the time that the parent has control, the time that they bought the 80%. That is the acquisition that they are talking about. Okay. So this is the time that we bought the 80%. That was the NCI. But the time that we bought the additional 10%, what would be the value of the NCI now? Okay. You can see that they have given you the net assets of Mandy at acquisition and also at the date of the acquisition of what? The additional shares. Okay. The net asset at acquisition is how much? The net asset at acquisition is
300,000.
300,000.
200,000.
Okay. The net assets at the date of acquiring the new shares, additional shares is how much?
$100,000.
Okay. What can we say about this? What will increase the net assets? What will increase the net assets?
Fair value.
No, the net asset basically that issue of additional shares can increase the net assets. Also, if there is a fair value gain in any of the instruments, can also increase the net assets. But basically, if no information is given about these things that I'm talking about, the issue of additional shares, when there is a fair value gain in the instrument that you are carrying through other comprehensive income, there also be an increase in the fair value. But what is going to increase the shareholders' value? The shareholders' value is the net assets. So what is going to increase the shareholders' value is the profits. If nothing is said about what is increasing it, assume that it is profits. So the only thing that can increase it is the profit, because the business is still operating. So they will make profit. So you can see that there's a difference of what? 100,000, which is post-acquisition profits, which is a profit made from the time that they acquired the 80% to the time that they are buying the additional 10%. Okay. During this period, what was the NCI share? During this period, what was the NCI share? The time that they are making the profit of 100,000, what was the NCI share? It was what? 20%. And the only thing that can increase the NCI is their share of the post-acquisition profits. So what you do now is that you find the share of the NCI post-acquisition profits. And that will give us how much? That will give us how much? 20% of
2,000.
that will give us 20,000. Am I correct?
Yes, 20,000.
20,000.
Okay. Then
Yes,
the
sir.
NCI at the date that we are buying the additional shares will be what? 120,000, isn't it? All right. This 120,000 represents what percentage? The 120,000 represent what percentage of the NCI? What percentage is equivalent to the 120,000 for the NCI? It's 20%, isn't it?
Yes.
Okay. But what percentage are we buying now? We are buying 10%, isn't it?
Okay.
It means that we are buying half of this. So the NCI will give us half of what they have. Or if you like, you can just do the additional percentage that you are buying over the total share of, or the total percentage of the NCI multiplied by their value as at the day that you are buying. So it will be 10 over 20 multiplied by 120, which is 60,000. Okay. But how much are we paying? How much are we paying for that? How much are we paying for that? How much are we paying for the 60,000? The top, it has just acquired a further 10% of money.
50,000.
50,000. Okay. So you can see that we are having a gain, isn't it? A gain of 10,000, but don't send a gain to retain earnings. Send it to other component of equity. So the double entry will now be you debit the NCI with 60,000 because that is what they will be giving to us. You credit cash. So debit the NCI because we need to reduce the NCI. Then you credit cash. You credit cash with 50,000. We are paying 50,000. Then you credit other component of equity with a difference. 10,000. Don't send the 10,000 to retain earnings as a gain. No. Don't send it there. We send it to other component of equity or other reserves. Other reserves. That is all. Let's pick a question. A whole question. Then we see how we go about this particular issue. Let's pick question 2.
Below are the statements of financial position as at 31st March 2017 for the age group, excluding X. Okay, statement of financial position.
Don't mind the name. You can put your name there.
It has in bracket excluding Springdale and then Springwood, another the same thing. Okay.
Okay. What they are saying is that the Hedison itself is a group on itself acquiring another company, which is the Springdale.
Mhm.
Okay.
Okay. So statement of financial position as at 31st March 2017.
Okay. So forget about that. Let's go to additional information.
Yeah. Additional information. The age group, which consists of age and a wholly owned 100% subsidiary, acquired 40% of the equity share capital of X on 1 April 2012 at a cost of 27 million Ghana cedis. At this date, the balance on X retained earnings was 22.5 million Ghana cedis. A fair value exercise was carried out, but at this time, it was determined that the current value of X net assets was a reasonable approximation of their fair value. B, the age group acquired a further 35% shareholding in X on 1 April 2016 at a cost of 35 million Ghana cedis. At this date, it was determined that the fair value of the original 40% holding in X was 30 million Ghana cedis. C, the investment in X are stated at cost in each statement of financial position provided. X profits for the year ended 31st March 2017 was 4.44 million Ghana cedis. Profits are deemed to accrue evenly throughout the year. E, at July 1, 2016, non-current assets held by X were determined to have a fair value of 2 million Ghana cedis in excess of their carrying value. These assets had a remaining life of 10 years at this date. Depreciation is charged to operating expenses. F, after July 1, 2016, H sold goods to X for 2.4 million Ghana cedis at markup of 20% on cost. Spring still held 1/5 of these goods at the year end. At the year end, H book showed a receivable of 800,000 Ghana cedis in respect of the transaction. This disagreed to the corresponding balance in X books due to cash in transit at the year end of 50,000 Ghana cedis. The H group's policy is to value NCI at acquisition at their fair value. The fair value of the NCI interest at July 1, 2016 was measured at 20 million Ghana cedis. As at 31st March 2017, goodwill on the acquisition of X was reviewed, and it was determined that an impairment loss of 1 million Ghana cedis should be recorded. The impairment loss should be charged to operations expenses. Required, prepare the consolidated statement of financial position as at 31st March 2017 for the age group.
Okay. You see, if you have a question like this, don't go and read the additional information. Okay. There are certain things that you can do. Just read the requirements. What are they asking you to do? Okay. They are asking us to prepare statement of what? Financial position for Hedison Group. So what you do is that just come here, have your Hedison Group. Have your Hedison Group here. Have your Hedison Group. So after having this, you can say consolidated statements of financial position as at 31 March 2017. So let's now count. So you have your assets. I said, then you go to the statement of financial position and look at how they were arranged. So you have non-current asset first. So you can bring the non-current assets. So the first one is what? Property, plant, and what? Equipment. So let me just put it. Okay, property, plant, and equipment. So property, plant, and equipment. Since they are having control, we prepare the account as if the two companies are a single economic entity. So what you do is that you pick the parent figure. What is their property, plant, and equipment? They have 69,710. Then we add the subsidiaries onto it. 89,560. Then you leave it open. Maybe something might happen, you come there. The parent is already having a goodwill because they are a group on its own. So pick their goodwill of 20,000. Then you come and add the goodwill that you'll be getting from this particular subsidiary. But if you don't have anything, you can decide to put investment in associate there. If at the end of the day you don't have anything over there, you can put 0 there. So you can leave this. The investment over here is the investment relating to the amount that they have in the group. So go and do that. How much did they acquire the first one?
20%.
Now they acquired 40% at how much? 27 Ghana cedis, isn't it? It was 27 million. The first one, the Henderson Group, which consists of Henderson and a wholly subsidiary, acquired 40% of the equity share capital of the Springdale on April 1, 2012 at a cost of 27 million. At this day, the balance on the retained earnings. So they bought it 27 million, isn't it? All right.
Yes.
The additional,
Yes, please.
the additional 35%, how much did they pay? The B, how much did they pay for it?
35.
35 million. So what will be the total amount that they have paid for all the shares?
That will be the 27 plus
35. And that will give us how
35,
much?
yes.
That will give us 62 million.
Yes.
Okay. But how much do we have here?
$70,000.
We have 70 million, isn't it?
Yes.
It means that there is a short of what? 8 million. Okay, come here. The C says that the investment in Springdale are stated at cost in Henderson's statement of financial position provided. So it means that they pick the 27 and also pick 35 and put it in the investment there. The difference, which is 8 million, means that the parent is having other investments. So you put other investment there so always try to reconcile the investments. So the total money that they are investing in. Yeah, someone wants to talk.
I'm sorry, please, but they said at this date, it was determined that the fair value of the original 40% holdings in S was 30 million.
Yes, they haven't taken that 30 million into consideration. They are just keeping it at the 27 million. So the investment in Springdale are stated at cost. The cost is the 27 million. So we are now coming to look at the fair value now, the fair value movement, because they haven't taken that into consideration. They are just keeping it at 27 million plus the 35 million that they have paid. Are you okay? All right.
Okay.
So if they should say something about the 3 million has been taken into consideration, then it means that they will now be having 65 million in respect of this particular investment. then they will be having other investment of 5 million. But since they say that they are stated at cost, it means that they are stated as their historical cost, which is 27 million and 35 million. So they are having other investment of 8,000. So you put the other investment there. You can come down and put your current asset there. Okay. The current assets, the first one is what? Inventory. So the inventory, let's put the two together. We have 1860 plus 1115. Okay, leave it open. Maybe you might be doing some adjustments. You have receivables. Receivables, you pick the 2920 plus 1960. Okay, then you come to cash and cash equivalents. So cash and cash equivalent, we have 4390 plus 1870. Okay, we can now leave that and come to equity and liabilities. Equity and liabilities. So we have the issued capital. We pick only the parent own because the subsidiary own will be cancelled with the parent investment. So the parent own is 50,000. So you can pick that one straightforward. If the parent didn't issue any shares, the retained earnings, the subsidiary own will be shared among the NC and the parent. So we do workings for it. Don't bring it. Don't bring any figure here. Then if you have any other reserve, no. Then you bring NCI there. Non-controlling NCI. We do workings for that. Then you count to non-current liabilities. Okay, this one they just give us a figure straightforward. So let's just add the two. We are going to have 25,000 plus 14,000. Okay, then let's come to current liabilities. Current liabilities. We have trade payables. The trade payables, let's add a 2. We have 1240 plus 1675. Taxation. Taxation will be 3210 plus 16. Okay, sorry, 1900. Okay, so let's now start tackling the additional information one by one. So let's start with the workings. So the workings, I'll put the workings on a different sheet. So let's start with the workings. The first working will be the group structure. State the group structure. So the group structure. The group structure. Okay. So the parent is having, what is the percentage holding of the parents? What will be the percentage that the parent will be having now? $40 plus 35. That will give us what? 75. The NCA will be having what?
25.
25. Then you put the two together to have your 100%. The next thing that you have to do is acquisition date, the time that they acquire the parent gain control over the subsidiary. So the acquisition date. What is the acquisition date now? The time that they gain the control, the time that they bought the 35%. What is that date? July 1,
1st July
1st July 2016.
2016. What is the reporting date? You state the reporting date. There is ticks for all these things. So this one, you not do any calculation for them. What is the reporting date? The reporting date, you can go to the top of the statement of financial position. That is the reporting date there. So the reporting date is what? 31 March 2017.
17.
So 31 March 2017. What is the post-acquisition period from the time that you gain control to the reporting date? How many months is that? Post-acquisition period.
9 months.
That would be 9 months. Okay. So you are done with this one. Then the next one is the net assets. You prepare the net assets of the subsidiary to know their value at acquisition and also at reporting. So the net assets, you do it at acquisition and also at reporting. Then if you like, you can add post-acquisition profit to it. You can add a post-acquisition profit to this side. All right. The net asset, we are talking about shareholders fund. So we are going to use the shareholders item, which is the first one is the issue capital or share capital. Issued capital or issued share capital. We assume that there is no additional issue of shares during the year. So the one at reporting will be the same as the one at what? Acquisition. So you go and pick the subsidiary figure, 40,000. We are keeping 3 zeros, the same 40,000. If you subtract, you have 0. The next item that will come is what? Retained earnings. But this retained earnings over here, you have to ask yourself which one will come at reporting and which one will come at acquisition. The figure given to you over here is the reporting figure. Included in this is profit for the year and also the retained earnings at the beginning of the year. So we acquired this particular company on 1st July 2016. It means that they have done April, May, June. They have done 3 months already before we acquired them. Come to this place. What are they saying here? What are they saying here? D, what are they saying? D. They are saying that Springer's profit for the year ended 31 March 2017 was what? 4.44 million. Profits are deemed to accrue what? Evenly throughout the year. So what we are coming to do is that what will be the retained earnings at the date of acquisition and what will be the retained earnings at reporting. Okay. The 4.4, this 4.4 over here is already included in what? In the retained earnings figure that we have over here. Do you agree? The 4.44 is part of the retained earnings figure there.
Yes, please.
Okay. So if we take that from that, then we know the retained earnings at the beginning of the year. But they have done 3 months before we acquire them. So the retained earnings that will be at acquisition will be the one at beginning plus the 3 month profit. Plus the 3 month profit. So what you can do over here is that you can just find 9 months of this, the 9 months of the profits, because we acquired them for 9 months. So you can find 9 months of the 4.44 and subtract it from the total retained earnings. Or you take the total retained earnings, which is 36,930. Then you subtract 444. Then you subtract 4440. Would that be 4440? Okay, you subtract it from it. What are we getting? I'm getting 32490. This will be the retained earnings at the beginning of the year, but they have done 3 months before we acquire them. So you now come and find 3 months of the profits. So 3 months of the profits, 3/12 times 4440. The answer that you get, you add it to the 32490. So let's do that and also try the other one. So 3/12 times 4440. I'm getting 1110. So I can just add this now, this plus this. I'm getting 33600. That is another way of getting the retained earnings at the date of acquisition. Another way of doing it is that, okay, the profit, which is a 4440, is 12 months, but we acquired them 3 months to the year. So the 9 months, which is post-acquisition profit, is included in the total retained earnings. So let me just find 9 months of the profit for the year and subtract it from the total retained earnings. Then you get the same figure. So let's do the 9 months 1, 2, and see. We are going to have 9/12 times 4440. I'm getting 3330. You subtract it from 36930. I'm getting 33600. It will be the same thing. So anyhow you do it, you are good to go. But the reporting figure, the retained earnings reporting figure, will be the one in the statement of financial position, and that will give you the 36930. Then your post-acquisition profit will be the 9 months profit. Will be the 9 months profit, which is 3330. Okay. We don't have any other issues for equity. Let's come to additional information and see whether there will be fair value adjustments. Let's see whether there will be a fair value adjustment. Okay. Let's come to the E. At July 2016, which is the acquisition date, non-current asset held by Spindle were determined to have a fair value of 2 million in excess of their carrying value. The net asset had a remaining life of 10 years at the date. At this date, depreciation is charged to operating expenses. What is the meaning of what they are saying? 2 million in excess of their carrying value. 2 million in the excess of their carrying value. What will be the effect of that on the net assets? Increase or decrease?
It will increase.
It will increase. So you come here, you have fair value adjustment, fair value adjustment, and that will give us 2 million, which is 2,000, and also 2 million, which is 2,000. Then this will give us 0. But let's come to another issue that they are talking about. They say this has a life of what? 10 years. Okay, let me go to my property, plant, and equipment and increase it, because this was not taken into consideration. So I'll come here and also increase the asset figure by 2,000, because we haven't taken into consideration the 2,000. So now they are saying that the asset has increased by 2,000. It means that we go and increase our property, plant, and equipment by 2,000. All right, let's come here. Let's say the asset has a remaining useful life of what? 10 years at this date. So the time that we are preparing the financial statement now, which is 31 March, would the assets still be 2 million?
No.
Why?
Because of depreciation.
Because we have used 9 months out of it. So we need to determine the current value of the asset now by depreciating it by 9 months. So let's depreciate that by 9 months. 2,000 over 10 multiplied by 9/12. I'm getting 150. Is that correct? Am I correct? I'm getting 150. Okay. assuming this 2,000 was there, we should have charged the depreciation to profit or loss, isn't it?
Yeah.
But we didn't do that. But under the net asset table, where can we see our profits? Where can we see our profits? Which of them? Reporting or closing? Reporting or acquisition?
Reporting.
Reporting. So you come and take it because the profit for the year is included here. So you take the 150 here, then you bring the 150 also here as subtraction. What will happen to our assets? The 2,000 that we have added, we should have added the 2,000. We should just subtract the depreciation before adding. So we now come and reduce it by 150. Are we good to go? Can we move on?
Yeah, let's go.
Okay. So let's now come. Let's now read and see whether there will be anything that will go to the net asset again. No, nothing will go to the net asset again. Okay, Hedison is the one selling, so there won't be any unrealized profit relating to the subsidiary. We are done with the assets. We are done with the profits. We are done with this particular information too, but we are here to finish the B. The A part is not relevant. The A part, mostly what they are telling you over there is not relevant, but it's only the 27,000 that we are going to pick over there. So let's come to our net assets. Let's find the total now. Okay, so we can see our post-acquisition profit there. The post-acquisition profit is what? So it's 3180. This will now be shared among the parents and then the NCI. So let's find the parent share first. Parent share will give us what? What is the parent holding? 75%. So 0.75 multiplied by 3180. What are we getting? I'm getting 2385. So let's count to the NCI own. NCI, you can just subtract the parent own from that one. There's no need for you to do any long calculation again, because this will be shared among the two. So the NCI is what? 79.5. The next working will be maybe calculation of goodwill. Let's calculate the goodwill. Okay. So that we start with how much is the parent paying their cash consideration. How much are they paying? So what is the total amount that the parent will be paying now for the 75%? Okay, let's look at the fair value of the initial investment. Fair value of the initial investment. Fair value of the initial investment is now how much? Fair value of the initial investment is now how much? The B. It's now
65 million.
No, the initial, the 40% is now 40, is now 30. And the 35, the additional investment.
Okay.
The additional investment. Don't bring the old figure. Don't bring the old 27. We assume that we have sold it to the subsidiary and rebought it at 30 million. So in this case, we pay 35 together with the 30 million. All right. So this will now give us 65,000 as the total consideration. Okay. Let me show the retained earnings at once so that I can be putting the figures in the retained earnings two at once. Okay. So let's come there. 4. Return earnings. So the return earnings, we bring the parent figure. What is their balance? What is the parent balance from the statement of financial position? So let's go to the parent balance, the one that they have gotten from their own trading. It is
89, 89,
okay,
89, 430.
89,430. So we bring down one. What will be the first thing that will increase it? It will be the fair value gain, isn't it?
Yes, sir.
Don't forget that one. Don't want this one, because you can even open the items down. Wherever you see some, you send it. Then before you go to another one. If you see one, then you go and do it. Do that one. Do that one very well before you go to another one. So the fair value gain will now be 30 minus 27. That will give us 3,000. So we bring the gain here. 3,000. We bring the 3,000 here. Okay. The next will be the post-acquisition profits, their share of the post-acquisition profits. How much did we get for them? We got 2,385 for them. So you can leave that, come to non-controlling interest, NCI. So you ask yourself, what is the fair value of the NCI at acquisition? Fair value at acquisition. The question will give you that, or they will ask you to calculate it. So let's look at the NCI at acquisition. Let's read down. We see the NCI at acquisition. So the Henderson Group policy to value non-controlling interest at acquisition date at their fair value. The fair value of the non-controlling interest at this one was measured at what? 20 million. So what will increase the NCI? It is the post-acquisition profits. So they are getting what? 715. Okay. So let's now move on to, we are done with this one. So we can now move on and don't go and say you are going to waste your time. Or no. Some of the adjustment that you can, if they give you the whole year, you'll be thinking, so leave those one. Before you start, go and put your items together, put your this thing down, because some of the items you will not waste your time before getting it. Put it down and come and take the additional information one by one. The one that you can do, deal with them. Then you move on to the next one. If one want to worry you, leave it small, come back and come and do it. All right. Let's come to the net assets now. We use the net asset at acquisition because we are buying this at acquisition. What is the value of the company at the time that we are buying them? It was 75,600. That is the total value. But out of this, how much is for NCI? So 75,600 minus what? 20,000. NCI was 20,000. So what portion is the parent paying for? What is the parent paying for? Okay. The parent is paying for 55,600. So we can now find our goodwill now, which is this plus this. So we are getting 9,400. Okay. The question now is, you go and ask yourself, this is goodwill at acquisition. Do you have any impairment concerning goodwill? You bring the impairment here. Do you have any impairment? H. Look at the H.
Anos.
Yeah.
20,000 from the net assets. Where is it from?
The 20,000.
Yes.
Is for the NCI. The net asset 75,600. That is 100%. And this is owned by the parent and the NCI. So you take the NCI portion, then you get a difference. That is the difference that the parent is paying the 65,000 for. Or if you also want to do the goodwill, I know the one that you know, where you add the NCI to the 65,000, then you take all the 75,600. You are adding the NCI because the NCI is already part of the net assets. So if you add, then the NCI that you are adding to the purchase consideration will cancel the NCI that you already have in the net assets. So anyhow you understand it, you can do the one that you know. All right. Are you okay now? Okay. So we can move on. So we can have impairment there. They are talking about impairment of what? 1 million. So the goodwill is going to impair by 1 million. So the goodwill that we are going to have at reporting, you can just send it there straightforward. So this will be the goodwill at reporting. Goodwill at reporting. Goodwill at reporting. Then go and add it to the goodwill that they already have. So the goodwill now is 8,400. You add it to the 20,000. Then they will now have 28,400. But what will happen to the impairments? How are we going to share the impairments? How are we going to share the impairments? Is it the parent who is going to have all, or it will be shared among them? Is it a parent who is going to take all? Is it going to be shared among them? The goodwill impairment, is it going to be shared among them?
Yes, please.
Okay, because we are using fair value. So the 1,000, we go and share it. So share of impairments. The parent will take what? 75. 0.75 times 1,000. And that will give us 7,500. This is an expense, so it will be a reduction. And NCI will take 25%, which will be, so impairment, NCI will take 25%, which will be 2,000. No, it's supposed to be 250. 250 and 750, sorry. It's not 10,000. So 250 and 750. Okay. So we are done with this. We are done with G. We are coming to F. We are done with E2, and we are done with D. We are done with C. We are done with B. We are done with A. We are now left with what? F. So you can see that there won't be anything that will affect the NCI again. So you can just total the NCI figure and send it to the statement of financial position. So the NCI, I'm having 20. I'm having 25. Let's go to NCI. 20,545. So you are done with the NCI. So you can move on. So let's now come to F. Let's now come to F and reconcile everything. So let's now come to F.
Hello, sir.
Yes.
Please say the fair value of the NCI, the 20,000, where do you get it from? I'm lost there.
It's G, the G.
Oh.
Can you see the G there?
Yeah. Sorry.
Okay. So let's now take the F. Then we know that, okay, we are now good to go. So the F, they say that after July 2016, Hedison sold goods to what? Spindle for 2.4 million at markup of 20% on cost. Spindle still had 1/5 of these goods at the year end. At the year end, Hedison books showed a receivable of 800,000 in respect of the transaction. This disagreed to the corresponding balance in Spindle's book due to cash in transit at the year end of 50,000. So what they are saying over here is that in Hedison books, they are saying that Spindle is owing them 800,000. And Spindle is saying that they are owing them 750,000 because they have sent a cash of 50,000 to them, but they are yet to receive it. So what do? Can the companies be owing themselves? The companies are like one company. Can they be owing themselves? Can they be owing themselves?
No.
No. So how much was included in Hedison's receivables? How much was included there? They have included 800, isn't it?
800.
800 because we are keeping 3 zeros. So we come and take the 800 here. But what will happen? We assume that they have received the cash of what? 50. So it means that they will receive the cash of 50. Then they are going to reduce their receivables by 50. Let's come to the trade payables. How much was included here for Spindle? How much are they including here? Read the information well. At the year end, Hedison books showed a receivables of 800 in respect of the transaction. This disagreed to the corresponding balance in Spindle's book due to cash in transit at the year end of 50,000. So how much will be in the books of the Spindle? How much will be in their books? Would that be 750?
Yes, it's 750.
Yes, because they are going to pay. So they should have 800 in the first place, but they have paid 50 out of it. So they will be including 750 here. We have canceled this particular transaction. So 800 from receivables, then 50 will go to cash. In all, we are reducing assets by 750 and also reducing liabilities by 750. All right, let's come to the other parts. After 1st July 2016, Hedison sold goods to Spindle for 2.4 million at markup of 20% on cost. Spindle still had 1/5 of these goods at the year end. What's the value of the goods that they are still holding? What will be the value? What will be the value of the goods that they are still holding? The value will be 1/5 of what? The 2,400. So 1/5 multiplied by what? 2,400. How much are we getting?
480.
480. So it is this 480 of the goods that were not sold yet. But the parent is assuming that they have sold all the goods. So they have recognized all the profits on the sale. But now the goods are not sold. It means that that portion of the profit on that particular goods will not be realized. So let's find a provision for unrealized profit. The 480 is a sales value. So you have to apply margin on it. But we are giving what? Markup. So what do?
20 over 120.
Okay. So that would
Change
be
into margin.
what? 1 over
20.
okay, 20 over 120. That will give us 1 over 6 multiplied by 480. Okay. What will be the provision?
80.
80. So we are going to take the 80 from what? The retained earnings of the parent, which is provision for unrealized profits. And the subsidiary also carrying the goods at what? Selling price, which should have been at cost. So they are carrying the goods at 480, but the cost should have been 400. So we go and take the 80 from the inventory. Inventory should be carried at lower of cost or its net realizable value. The cost is 400, the net realizable is 80. So you go and bring it down to the cost. All right. Let's now add the retained earnings. Okay, retained earnings, I'm getting 993 985 93985 93985. Do you have to, so we just total all of them? That is all. 93985 93985. Okay, so let's go and put all of them together. Inventory, what will be the inventory value? 1860 plus 1115 minus 80. So I'm having 2895. Let's come to receivables. 2920 plus 1960 minus 800. I'm having 4080. 4390 plus 1870 plus 50. I'm getting 6310. Let's go to property, plant, and equipment. 69710 plus 89560 plus 2000 minus 150. I'm getting 161120. Okay. So let's put all of them together. So our total assets will be that. Let's come to our non-current liabilities. 25,000 plus 14,000. That'll give us 39,000. Trade payables. 1240 plus 1675 plus minus 750. I'm getting 2165. Okay, taxation 3210 plus 1900. Getting 155. Okay, let's put them together. this plus this plus this plus this plus this plus all right. So that is step acquisition for you. The question will always come in this form. It will not be from control to control. No, from control to control, there is no more issues there. It will be from non-control to control, where you are going to value the initial investment. So the question will always be like this. Intervention, we solve additional one. We solve additional one question to this one. Then we know that, okay. Okay, they are here plenty. So we solve additional one to that one. Then that is it. So this is all about step acquisition. We are going to look at disposal. Step acquisition, the question that they will give to you will always be statement of financial position. If they should bring a question, it will always be statement of financial position. And the question that they will bring to you is where the parent is not having a control. Now they are having a control. But the ones that they are going to have control before they will buy additional portion, that one, there is no major issues with that one. There's no major issues with that one. So that one, if they want to bring it, maybe it will be statement of profit or loss. That will be statement of profit or loss. But the one that they are going to bring for statement of financial position, step acquisition is always about a statement of financial position. They have not yet brought any question on statement of profit or loss for step acquisition. Okay. So it always be statement of financial position from non-control to control. From non-control to control. All right. Let's look at disposal. Disposal is similar to step acquisition. Disposal is similar to step acquisition. So disposal is similar to step acquisition. Let's look at disposal. How we can move on? Okay. Let's look at disposal. Disposal is a situation where the parent is now seeing the subsidiary that they are not profitable. They are not profitable, so they want to sell it. They want to sell their shareholding to someone. They want to sell their shareholding to someone. They can decide to sell their entire shareholding. So if the parent is having 80%, they can decide to sell if the parent is having 80%, they can decide to sell all, or they can also decide to sell 20% of it. If they sell 20% of it, they'll be having remaining 60%. They still have control, so they will still consolidate. Okay. But they can also decide to sell 40% of it. They are going to have a remaining 40%. They have lost control. So what they will do is that they will account for this as investment in associates. So if they have sold some of the shareholding and the one left is less than 50, but more than 20%, they will account for that as investment in associates. But if they have sold all, they won't have anything. But if they have sold some and they still have control, more than 50, they will still continue consolidating the account as if nothing happened. But what will happen is that we assume that they have sold that portion to the NCI. They have sold that portion to the NCI. Okay. But if they sold 70 and now have 10%, then they will account for the 10% as financial assets through IFRS 9 financial instruments, where they will decide to classify it through other comprehensive income or through profit or loss. So for disposal too, we have two situations: from control from control to non-control. So from control to non-control is a situation where they have sold 40% of the 80 and they are having what? 40%. Or it's a situation where they have sold 70% and they are having 10%. So if they say disposal from control to non-control, it's a situation where you have sold the portion of the shares that you have and the remaining one is less than 50%. It's less than 50%. Then we say that is from control to non-control. But it can also be from control to control. From control to control is a situation where they have sold 20% of the 80 and they still have what? 60%. So they still have control, so they will start consolidating. But if they lost control, how do we do? If they lost control, what will happen? If they lost control, they have to find profit on the disposal. So if they lost control, they have to find profit on the disposal. So what do? You ask yourself, what portion of the shares are we selling? So they are selling 60% and they are maintaining, they are selling 60% and they are maintaining 20%. Okay. So the question now is, how much are they selling the 60% for? Assuming it's 20,000. Assuming it's 20,000. Okay. What they will tell you that they will also give you the value of the remaining portion, the value of the retained shareholding. So they can give you this one 5,000. So they can give you the value of this, which is 5,000. They can give you the value of this, which is 5,000. Okay. What will happen is that at this date, they will give you the value of the net assets. So the net asset at disposal. Assuming the net asset at disposal is 40,000. But this is excluding goodwill. The goodwill is relating to the subsidiary. So let's assume that the goodwill at disposal is 5,000 plus the net asset. So the total will give us 45,000. Okay. So this 45,000, they can give you NCI portion. So the NCI at reporting, the NCI at the date of disposal is 20,000. It means that the parent portion of the net asset will be 25,000. But the parent is not selling all. They are selling only 60%. And they are Is it okay now? Okay.
Yeah, let's go on.
Okay. So they are selling the parent portion of the net asset now is 25,000. But the parent is not selling all. They are not selling all the entire investment. They are selling 60% and they are maintaining 20%. That 20% is 5,000. That 20% is 5,000. So since that portion is 5,000, it means that they are selling 20,000 for 20,000. They are not making any profits. But if the one that they are retaining is 7,000, it means that out of the 25,000, they will retain 7,000. So they are selling only 18,000. So you find the 18,000, then you go and adjust the 18,000 against the amount that they are receiving, which will give us the 2,000 profits. All right. This is what we do. But what we do is that they will give you a long format. No. At the date of the sale, just ask yourself, what is the total value of the net asset of the subsidiary? What portion relate to the NCI? Take the NCI out. If you take the NCI out, that is telling you that that is the parent portion. If the parent is selling all, then that is the cost. But the parent is not selling all. It means that part of it will remain. So you find the portion that they are retaining from the total parent value. The one that you are going to get will be the one that they are selling. You compare with the consideration that they receive, and that will give you profit or loss on the disposal. But what they will do is that because we all like formats, all these things that I've said, let me just put it in a format for you. Okay. Let me just put it on format for you. So the profit on disposal, you start with the process. Start with the process. Start with the process. The process from the disposal. So if you have the process, put it here. Then you have the net assets. The net assets. So this net assets, you can put them together. Fair value of the net assets at acquisition, at disposal, at the date of disposal. So you put it there. So assuming this was this, and this. So if the goodwill is not part, you add a goodwill because the goodwill relates to the subsidiary. So add a goodwill. So if you add a goodwill, that will give you the total value of the net assets. So the total value of the net assets. Total value of the net assets. What is the NCI portion? Because this is the total value is for both the parent and the NCI. So you take the NCI portion. You take the NCI portion. Then if you take the NCI portion, the figure that you are going to get will be relating to the parents. So the parents portion. The parent portion. The parent portion will be this. Is the parent selling all of this? If yes, then this will be the cost against the process. The parent is not selling all. What is the portion retained? So interest retained. So the interest retained will be taken from the total because we are not selling all. So what is the interest retained? We take it from the parent share. Then we bring that particular difference now to have our gain or this one. Okay, I will show another one again. Okay, another way of doing this is that just take the process. I wonder if you can remember all these things in the exam. That is why you should just understand it. All right. Then you add interest retained. You add the interest retained. You add the interest retained. Then you add the NCI at reporting. Then you now come and subtract net assets. You subtract the net assets. You subtract the net assets. Then you subtract the unimpaired goodwill. The goodwill that you have, the carrying value of the goodwill as at the date of the disposal. You subtract it from it. Goodwill rather. So goodwill. Then you subtract the goodwill also from that figure. So the figure that you are going to have will be profits on the disposal. Very simple. So if you can understand this in the exam hall, no problem. So you can see that instead of you adding the interest retained and this one, you can also go ahead and come and subtract the interest and the NCI from these figures and now take the remaining figure and adjust it, which is the first one that we did. All right. That is from control to non-control. From control to non-control. If the parents, after the sale, the parent is having less than 50% shareholding, then the parent must calculate again on the disposal. But if the parent dispose some portion and they are still having control, no profit should be determined on the sale. Rather, we should assume that the sale was between the NCI and then the parents. So the parent is having 80%, and they sold 20%. They still have 60%, which is giving them control. So what will happen is that we assume that they have sold the 20% to what? To the NCI. So what will happen? We need to find the value of the parent portion as at this date. How do we find the value of the parent portion? We find the total value of the subsidiary. Then we take the NCI portion from it. So if the total value of the subsidiary was 200,000, as at the date that the parent is selling the 20,000, and the NCI figure, the fair value of the NCI as at that date is 50,000. It means that the parent is having 150,000, which is equivalent to 80%, which is equivalent to 80%. So out of the 80%, the parent is selling 20% to the NCI. So what do? We find the 20 over 80 multiplied by the parent's portion, which is 150. And if you get 2,000 or 15,000, that is the portion that you are transferring towards NCI. That is the portion that you are transferring to the NCI. So let's assume that this was 10,000. That is the portion that you are transferring to the NCI. But how much would the NCI pay for it? So if NCI pay, maybe NCI, the cash proceeds that we received from them was 12,000. It means that we are having a gain of 2,000. This gain will be sent to other components of equity, like the one that we did under step acquisition. So any loss or gain on the transaction will be sent to other component of equity. So the parent will transfer 10,000 to NCI and they will receive 12,000 as cash. So you debit the parent investment, you debit cash, credit parent investments, or you credit NCI because you are transferring this to NCI. So you credit NCI, you credit other components of equity with 2,000, NCI with 10,000, and cash proceeds with what? You debit cash with 12,000. You debit cash with 12,000. So that is all about this one. If it is from control to non-control, we calculate profit on the disposal. If it is from control to control, we don't do anything. We continue consolidating. But what we do is that we assume that the sale is between the NCI and the parents. So we just find the parent portion and transfer it to the NCI. Let's take one example here. Let's take one of the illustrations and we move on. Okay, let's take the example one.
Rock.
Okay, yes, Rock, let's move on. Rock.
Rock acquired a 70% investment in D for 2,000 Ghana cedis 2 years ago. It is group policy to measure NCI. Please, the person said. It is group policy to measure NCI's interest at fair value at the date of acquisition. The fair value of the NCI at the date of acquisition was 800 Ghana cedis, and the fair value of these net assets was 1,900. The goodwill has not been impaired. Rock has made a disposal of shares in D. The net assets of D recorded in the consolidated financial statement at the date of disposal were 2,400. Rock pays tax at 30%. Required. Rock has disposed of all 3,000 Ghana cedis. Calculate the I should continue.
Yeah, continue.
Calculate the profit or loss on disposal that would be recorded in Rock's individual statement of profit or loss, including the tax charge. The Rock Group's consolidated statement of profit or loss, including the tax charge. Now, assume that Rock disposed of half of its shares in D for 1,500 Ghana cedis, and that's the remaining holding had a fair value of 1,300 Ghana cedis at the date of disposal. Calculate the profits or loss on disposal that will be recommended in the consolidated statement of profits or loss, ignoring any tax effects. Explain how the residual holding would subsequently be accounted for in the consolidated statement of financial Rock Group.
Okay.
Subsequent, please should I add that?
No, forget about that one. The subsequent measurement of any investment return will either be a financial asset or investment in associates. I've said that already. So Rock acquired 70% investments in Dock for 2,000 2 years ago. It is group policy to measure non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest at the date of acquisition was what? 800. And the fair value of Dock's net assets was 1,900. The goodwill has not been impaired. Rock has made a disposal of shares in Dock. The net asset of Dock recorded in the consolidated financial statement at that date, at the date of disposal, was 2,400. Rock pays tax at 30%. Rock has disposed all of its shares in Dock for sale proceeds of 3,000. Calculate the profit or loss on disposal that will be recorded in Rock's individual statement of profit or loss, including the tax charge, the Rock's consolidated statement of profit or loss, including the tax charge. So let's now come. First of all, what is the consideration paid at the time that they are buying the Dock? At the time that Rock is buying the Dock, what was the consideration paid?
2,000.
2,000. Okay. They were paying 2,000. So, and what was the net asset as that date?
Yeah. 1,900.
1,900. And what was the NCI? 800.
800.
What would be the goodwill? What would be the goodwill as at the date of acquisition? What would have been the goodwill? What would be the goodwill? What would be the goodwill?
$100.
Are you sure? The net asset is 1,900, which is for both the NC and the parents. NCI portion is 800. What would be the parents' portion? So the parent is paying 2,000 for what? What they are paying it for, the net asset is, they are paying it for 1,100. Am I correct? Am I correct? The goodwill can only be 100 if the parent is buying the entire investment. If the parent is buying the entire investment. So if the parent is buying entire investment, it means that they are buying the total value of the company. They are buying the entire company. But this one is saying that the value of the company is 1,900. But this one is owned by the parents, and then the portion of the parent is not owing, or the portion of the parents is not owning. But they say that the total value of the company is 1,900. The parent is having 70%, and someone is also having 30%. They say that the people having the 30% are having, their value is 800 out of 1,900. It means that the parent one will be 1,100. So the parent is paying for 1,100. How much are they paying? They are paying 2,000. So they are having a goodwill of what? 900. All right. So the goodwill is 900. Let's come now. Rock has made a disposal. Rock has made a disposal of shares in Dock. The net asset of Dock recorded in the consolidated financial statement at the date of disposal were what? 2,400. Were 2,400. Were 2,400. Okay. Rock has disposed all of its shares in Dock for sale proceeds of what? 3,000. So let's now calculate the gain on it. So let's say we should calculate the gain on the Rock's individual statements. So the gain on the Rock's individual statements, Rock will just classify the investment at the cost. So we are going to have the sales value of 3,000 and the cost will be 2,000. So they will classify the investment at cost. So they'll have 3,000 against 2,000. They are making a gain of 1,000. So since this is in their individual statements, the gain, they will pay tax on it. They will pay tax on it, and the tax rate is 30%. So 30% on this one will give us 300. So including the tax, they are going to show a net gain of 700. That is in the individual statement of. That is in the individual statement of Rock. But let's come to the consolidated statement now. The consolidated statement, what will happen is that Rocks must show the gain on the disposal. So this gain is the one that we did first. In the consolidated statement of financial position is the one that we did first. Okay. What is the process? How much are they selling? How much are they selling the entire investment? How much are they selling the entire investment? 3,000. Okay. But what is the net asset at the date of the disposal? The net asset at the date of disposal is what?
1,400.
But this is for Rock and what? NCI, isn't it? So you have to find the NCI portion and take it. Okay. You have to find the NCI portion and take it. Okay. Let's now count. What was the NCI value at the date of acquisition? It was 800, isn't it? All right. The net asset was 1,900. But now they are saying that it is now 2,400. What is happening? The net asset has increased by how much?
500. 500.
500. This 500 represents what?
Capital gain.
500.
The 500 represents what?
Profit.
Profit. So we share this profit, then the NCA will have their portion. So the NCA will be having 30% of that. So 0.3 times 500. So NCA will be having 150. But NCA at the beginning was 800. Now they are having 150. NCA will now be what? 950. Okay. So it means that included in the 2,400, we are having NCA portion of what? 950. But there's a goodwill relating to the what? To the subsidiary. So what we do is that for us to know the total value of the subsidiary, the goodwill relate to them. So we take their net assets because goodwill is not included in the net assets. So take the net assets, 2,400. Then you add the goodwill to it, 900, because they say the goodwill has not impaired. So the total value of the subsidiary will now be 3,300. But out of this, NCI is 950. So what will be the parent portion? What will be the parent portion? 2350. Am I correct? And again will give us 650. And they say this one including tax. So profits, we show the tax. We don't calculate tax on the gain. So you just pick the tax that they will pay in their individual statements. So you bring the 300. So the gain will be 350. The net gain will be 350. That is very simple. Okay. The question looks simple, but it's not simple. It is what it is. Okay. They say that you should assume that, now assume that Rock has disposed half of its shares in Doc for 1,500. The remaining holding had a fair value of what? 1,900. This one is very simple. The value relating to Rock is 2350. But now they are saying that they are not selling all, they are retaining 1,300. So it means that they are selling 1050 for 1,005. So they are going to have a gain of 450. Very simple. Or you can do it like this. You have your proceeds. You have your proceeds of 1,500. Then you add the interest return. The interest return is 1,300. You add the NCI at the date of disposal, which is 950. Is 950. Then the total is what? Let's total that and see. So I'm having 3750. So what you do is that you subtract your net asset at the date of disposal, but these net assets are excluding goodwill. So you bring your goodwill, your unimpaired goodwill, which is 900. You bring the goodwill 900. So you subtract this, then you have minus this, minus this. You're having 450. That is very simple. All right. The disposal, the question that will come will always be statement of profit or loss. But last one time they brought question on statement of financial position. That was a surprise and shock. But if they will bring a question on statement of financial position, it means that the parent will still be having another subsidiary. But if you are having only one subsidiary and you dispose them off and you are going to lose control, it means that the parent will prepare the account for him or herself. But if they are having more than one subsidiary, it means that they will still consolidate the other subsidiary. So mostly the disposal question will be on statement of profit or loss. Will be on statement of profit or loss. Let's pick one statement of profit or loss question. And so if you have disposed your investment, if you have disposed your investment for maybe the year starts January, the year starts from January, and you dispose your investment in July or 1st July, it means that you are having control over the subsidiary for 6 months. So if you're preparing statement of profit or loss, you consolidate the account for 6 months. That is from January to June. But from July to December, you now ask yourself whether you are having a significant influence or you only carry the assets, you only carry the investment as a financial asset. If you're having a significant influence, then you account for the investment as investment in associate, where you are going to show the profits of the associate profit for 6 months. So if you're preparing statement of profit or loss, even if you have control over the subsidiary for 3 months before you dispose it, you are going to consolidate for 3 months. If it is 4 months before the disposal, because that 4 months you have control over them, so you are going to consolidate for that 4 months. For that 4 months, let's pick a question. But if you sold but the control is still there, you consolidate as if nothing happened. But just that if you are sharing your profit, your NCL portion will now increase. NCL portion will now increase. Let's pick question 1. Let's pick question 1. It will always be statement of profit or loss. Let's pick question 1. Auntie Oli. Auntie Oli, are you there? Auntie Oli, are you there? Auntie Olivia, are you there? Someone should read for us so that we resolve this question. And complex group, I'm not seeing the complex group to come, but let's see what happens.
The statements of comprehensive income for 3 entities for the year ended 30th September are presented below. Should I go to the additional information?
Yeah, just go to the additional information straightforward.
SALT acquired 160,000 of the 200,000 Ghana cedis issued ordinary share capital of PB on 1st May 2017 for 2.8 million. The reserves of PB at May 1, 2017 were 2,050,000. A year-end impairment review indicated that goodwill on acquisition of PB was impaired by 10%. The group policy is to charge impairment losses to administrative expenses. The group policy is to value non-controlling interests at the proportionate share of the fair value of the net assets at the date of acquisition. B, the fair value of the net assets acquired was the same as the book value with the exception of property, plant, and equipment, which was higher by 960,000. I'll go up. The uplift in value related to a depreciable property with an estimated total useful life of 50 years. At the date of acquisition, PB had owned and used this property for 10 years. The group policy is to charge depreciation on burden and administrative expenses on a monthly basis from the date of acquisition to the date of disposal. C, SALT disposed of 40,000 Ghana cedi ordinary share of UV on 1st July 2017 for 960,000. SALT had acquired 75,000 of the 100,000 Ghana cedi issued ordinary share capital of UV for 980,000. 1st November 2014, when the balance on the reserves was 1,020,000. The fair value of the shareholdings retained at 1st July 2017 was 792,000. There was no evidence of goodwill having been impaired since the date of acquisition. The reserves of UV at 1st October 2016 were 1,300,000. The PB paid a dividend of 100,000 on 1st September 2017, and SOT had recorded its share in investment income. SOT holds several investments held as fair value through other comprehensive income and accounts for this in accordance with IFRS financial instruments. Gains on subsequent measurements of 46,000 occurred in the year. The financial controller, however, is unsure how this should be presented within the statement of comprehensive income, and so has yet to include it. SOT also dispose of an investment held at fair value through other comprehensive income debt instrument during the year to 30th September 2017 for 630,000, when the current value of the investment was 580,000. The gain on disposal of 50,000 is included in administrative expenses. Previously recognized gains associated with this investment of 40,000 still remain in other reserves. Assume that all income and gain for the three entities accrue evenly throughout the year. Ignore any further tax impacts of investment held as fair value through other comprehensive income. Round all figures to the nearest thousand required. Prepare the consolidated statement of comprehensive income for the SOT group for the year ended 30th September 2017. These statements of financial position.
So when is this thing?
30th September.
Okay. So let's now look at when they acquire the first one and when they dispose the first one. Okay. When they acquire the BP. So SOT group consolidated statement of profit or loss. And other comprehensive income for the year ended 30th September. Okay, so let's now ask ourselves. I hope they are keeping 3 zeros. Okay. When did they acquire the BP? When did they acquire BP?
First May.
So you first have to ask yourself, do they have control or just a significant influence? They are acquiring the 160 of the 200,000 shares. So how do we determine the control on that particular
60 over 200,000?
80%.
80%? It means that they have control. Okay.
Yes.
But from this date to the reporting date, how many months is that? How many months is that? The reporting date is 30th September 2017. We acquired them on 1st May 2017. So May, June, July, August.
6 months.
May, June, July, August, September. It's 5 months. It's 5 months. Am I correct? Is it 5? May, June, July.
It's 5.
It's 5. Okay. So what you do is that you can start by bringing all the parent figures. Then you now ask yourself how you are going to consolidate the rest. So the parents, you can bring the parent revenue first before you come and ask yourself how you consolidate the rest. So you can have the cost of sales, the parent own cost of sales. That will be 3,600. Gross profit, just leave it like that, because anything that you do against those one will bring you that figure. So you have administrative expenses. Administrative expenses. So administrative expenses for the parent is 760. Distribution cost. Distribution cost, the parent own is 800. Investment income. Investment income is 80 for the parents. And you have finance cost for the parents is 360. So you can have the income tax. Income tax. Okay, let's have the profit before tax. Profit before tax, don't do anything. Then you have the income tax, the parent figure. Just bring the parent figure. Income tax is 400. Then you have profit for the year. You have profit for the year. Then other comprehensive income. Then you have actuarial gain. Actuarial gain. The parent figure is 110. You have tax effects. You put a tax effect, the parent one in brackets. So with this, you can now start tackling the information one by one. So let's take the first one. So the first one, the parent is having a control of what? The parent is having a control of 80%, starting from which date? 1st May, and this is 5 months. So we go and pick BP items and prorata it for 5 months, because the question says that assume that all income, assume that all income and gains for 3 entities accrue evenly throughout the year. So it means that these are the same every month. So we just take 5 months of all the items relating to BP. So plus 5/12 multiplied by BP is what? Revenue, which is 6240. We do the same thing for cost of sales. Plus 5/12 multiplied by 3360. We come to administrative expenses, we do the same thing. Plus 5/12 multiplied by 740. We come to distribution cost, we do the same thing. Plus 5/12 multiplied by 700. They don't have any investment income, but we come to finance cost. Finance cost for them will be 240. So plus 5/12 multiplied by 240. Income tax. Income tax for them will be plus 5/12 multiplied by 360. Other comprehensive income, actuarial gain, they don't have any. And tax effect, they don't have any. So leave that particular information, don't do anything. Come to the UV, come to C. Let's come to C. Let's know how we are going to add the figures first before we start tackling the additional information one by one. So let's look at the C. The SOT disposed 40,000 ordinary shares of UV on 1st July 2017 for 960. SOT had acquired 75,000 of the 700,000 1 cedi issue ordinary shares capital of UV for 980,000 on 1st November 2017, when the balance on reserves were 1,020,000. The fair value of the shareholding retained at 1st July 2017 was 792,000. There was no evidence of goodwill having been impaired since the date of acquisition. The reserves of UV at 1st October 2016 was 1,300. 1,300. All right. So first of all, we have to calculate the percentage that we are having. What will be the percentage that they were having first? What will be the percentage that they were having first? 75 over 100 times 100. They were having 75%, isn't it? Are we here? Are we here? Can anyone hear me?
We can hear you, sir.
Okay. They were having 75% first, which is a 75,000 over 100,000. But now they are selling 40,000. So we now need to ask ourselves, what is the control that they are selling? What is the portion of the control that they are losing? So that will be 40 over 100 times 100%. So they have 75. They have 75 and they are now selling 40%. It means that they are going to retain what? 35 what? Percent. It means that they have lost control. They have lost control. But the question is, from the start of the year to now, how many months did we have control over them before we disposed? We disposed them on 1st July, but the reporting period is 30th September. So July, August, September. It means that we are having them for 9 months. We are controlling them for 9 months before the disposal. So what we do is that we will consolidate them for 9 months because we have a control over them for 9 months. So go and consolidate the account for 9 months. So 9 over 12 times their revenue. So let's go and take their revenue before we come to the. So their revenue is 5280. 5280. So 9 over 12 times 5280. Then their cost of sales will be, we also add this plus 9 over 12 multiplied by cost of sales 2880. We come to administrative expenses plus 9 over 12 multiplied by 650. 650. Okay. Distribution cost, we have this one plus 9 over 12 multiplied by 550. So we count investment income, I don't have any. Finance cost, what do they have? Plus, finance cost will be plus 9 over 12 multiplied by 216. Okay, we come to their income tax, we have plus 9 over 12 multiplied by 300. Other comprehensive income, do they have actuarial gain? They have 40. So we have plus 9/12 times 40. They have issue about tax effect too. So we have plus 9/12 multiplied by 15. So that is the first one. So we can now start adjusting our figures one by one. So the first one, let's take the first one. So XOT acquired 160,000. We have determined the percentage holding to be 80%. So right now we can go and calculate our goodwill on this particular transaction. So let's calculate our goodwill now. So the goodwill, let's now determine the goodwill for them. So the goodwill will be the consideration that we paid, purchase consideration. How much is the consideration paid? How much do we pay for the shares that we have acquired? How much was paid? Additional information A, how much was paid? $2.8
million.
Okay. So 2.8 million. Do you know the NCI value? They say the NCI is the proportionate of what? NCI is the proportionate of the NCI portion is proportionate of, so the NCI, the group policy is to value the non-controlling interest at a proportionate share of the fair value of the net assets at the date of acquisition. Okay, so let's come to our net assets now. For profit or loss, we don't do a net asset table. So we just calculate the net assets at acquisition. So the first one will be the share capital. What is the value of the share capital? What is the value of the share capital? Can you determine that from the question? What is the total shares that they have? What is the total shares that they have?
200,000.
And one share is what?
1 cedi.
So what will be the value?
200,000.
Okay, 200,000. What was the reserves as at that date? What was the reserve as at that date? So the reserves, they have given you that reserves already. What they normally do is that they can give you opening reserves, reserve from the start of the year. So what you have to do now is that you have to come and find the 7% of the profit for the year and add it to the opening reserve. But this one, they were good enough to give us the reserves as at the date of the acquisition. So this will give us 200. If we are keeping 3 zeros, then it will be 200. Okay, then the reserve will be 2050. Do you have any fair value adjustment? Look at the B. Do you have any fair value? Look at the B there. $960. So there will be an increase of 960, isn't it? So this 960, let's just adjust it and find the depreciation on it already. So 960 divided by what?
Yeah.
Which year are we going to use? What will be the useful line that we use? Read the footnote well, the C, the B, read it well. This was increased by 960. So this relates to a depreciable plant with estimated total life of 50 years. At the date of acquisition, BP had owned and used this property for 10 years. The group policy is to charge depreciation on building to administrative expenses on monthly basis from the date of acquisition to the date of disposal. So how many years are we going to use?
40 years.
40 years.
40
50
years.
years. They have already used 10 years out of the 50. So the remaining useful life will be what? 40. Multiplied by what? 5 over what?
12.
12.
12.
What will be the answer? I'm getting 10. Is 10 correct?
Yes, 10 is correct.
Okay, so I will just, they say they are adding it to administrative expenses. So I'll go and add this to what? Administrative expenses. 10. Okay, but let's go back to this one. This one, since it has acquisition, we don't do anything. We do only the depreciation at reporting. This one is at acquisition. We are not using the asset. We didn't start using the asset yet, so we can't depreciate it. Okay, what would be, there's no other fair value again. So what would be the total value of the asset at acquisition?
What depreciation number?
So I'm having 30.
But
This is the total value. But what is happening? The NCA is having how much? What will be the NCA portion? NCA is 20%. They haven't given us a fair value. So we find the 20% of this. Or you can even find 80% of it because NCA will take 20. So let's find the parent portion, which is 80% of that and subtract it over here. Or let me just bring the NCI. So 0.8 times 3210. I'm getting 2.568.
How many percent?
80%.
3210. 640.
So NCA will be 642.
20%.
So you can just put it here. Then what will be our goodwill? The goodwill will be the difference between this and this. I'm getting 232. Okay. That is a goodwill. But what are they saying? A year-end impairment review indicated that goodwill on acquisition of BP was impaired by 10%. The group policy is to charge impairment losses to administrative expenses. So let's calculate the impairment on that. What will be the impairment on that? 10% on that.
Uncommon.
23.2, isn't it? But they say run all figures to the nearest what? 1,000. So since we are keeping 3 zeros, let's just put 23 there. All right. So why are we going to add it? We will go and add it to administrative what? Expenses. They say it is a policy of them to add it to administrative expenses. So plus 23. We are done with the first one. We don't have anything to do with the first information. The second one too, we are done with the second information. But let's now count to C. Let's now count to C.
Did you have a 10 or guardian?
Depreciation in
10 or depreciation.
Let's now count to C. The C. What are they saying about the C? Let's do the C first.
You are correct. 1 mind.
In one of my papers,
Let's look at the C. There's no time. Then this one, it means that there's the complex group. I mean, last sitting was complex group, so Charlie, it's okay. Step acquisition, disposal, cash flow, and foreign subsidiary, you're okay. But just pray that you won't go there, step complex group will come in.
Again.
All right. So let's look at the C. Let's look at the C now. COT dispose of 40.
Disposal. And Koreans are aware.
So COT dispose
I remember recession.
dispose of 40 shares.
No.
I see that.
Who is that making noise like that?
Too many.
Okay, let's look at this one. So the person disposed of 40% of the ordinary shares of these people for 960. COT had acquired 75,000 of the shares for this and this, for 980, this and this on November 2014, when the balance on reserves was this. So let's find the goodwill arising from this one first before we determine the gain on the disposal. So if you want to know whether they are losing control or not, find the percentage holding that they are having first, which will be 75,000 over 100,000. That will give you 75%. Now the one that they are selling, it will be 40,000 over 100. That will give you 40%. 40 from 75, you are having 35. That is less than 50. So they are losing control. So you can calculate a gain on this particular transaction. But before this, what was the goodwill relating to it? Because if you are selling or you are selling the goodwill also together. So we have to find the goodwill first. So the goodwill first, we start with the consideration that they paid, purchase consideration. And that was, purchase consideration was, they paid 980,000 for that. 980,000. So we are keeping 3 zeros. So they paid 980 for that. So they say they acquired this one share capital of this for this. So let's now come. We are now coming to determine our net assets and subtract it from the value that they are paying. So net assets. So the net assets, we have the share capital. So what is the share capital? The share capital for them will be 10,000 because their total share is 100,000 at 1 cedi. So that will give us 10,000. 100,000 rather. Okay. The reserves as at that date, when the balance on reserves was this. So the reserves was 1020. The reserves was 1020. So reserves was 1020. So let me make this one to be 100. We are keeping 3 zeros, and this will be 1020. Okay. There is no fair value movement as at that date, but the value of this one retained on this is this one. Okay. There was no, they didn't give us this one, the NCI. Okay, they didn't give us the NCI, so we are going to use this statement. The group policy is to value non-controlling interest at the proportionate of the share value. So we assume that they are using this policy also for the UV, because they haven't given us anything about the NCI value. So we also use the proportionate method for this. So the reserves, there was no fair value movement as at that date. Then we just pick. So we add the 2. We are having 1120. That will be the total net assets. We find the NCI portion of that. So the NCI will be 25% because they are previously having 75%. So NCI portion of 25%. Yeah.
This was I've seen some fair value of 792 there.
The 792. 792 is the one that they retain after selling. So the 792 is after selling, but we are now coming to calculate the goodwill as at the time that they bought it. They bought them. Okay, so this one will be relevant if you are calculating the gain or the profit on disposal. So we are having 840. 840 will be the portion that the parent is paying for. So the goodwill will now be this plus this. So the time that they bought this thing, they're having a goodwill of 140. But they say there is no indication that the goodwill has impaired. There is no indication that the goodwill has impaired. So we have NCR of 280 surplus. There is no indication that goodwill has impaired. So let's come to this particular transaction itself. Okay, let's come to the transaction itself. Let's calculate the profits on disposal. Profit on disposal. Profit on disposal. So the first one is the proceeds. What is the proceeds that they are getting from the sale? How much are they selling the shares for? They are selling it for 960. Am I correct? Am I correct? So the interest return, how much is the interest return? How much is the interest return? The interest return is what? 792. 792. So we now add the NCR value at disposal. But the NCR value after the date of acquisition was 280. But the question now is, from that time up to today, up to the time of disposal, which is 1st July, what should have been the NCI value? So we now have to come and calculate the post-acquisition profit from the date of disposal from the date of acquisition to the date of disposal. Okay, they have given you results for this particular results at the beginning of the year were to be 1,300. Okay, so that would be 1,300. But what was the results at the acquisition date? It was 1020. So what would be the post-acquisition profit as to the beginning, up to the beginning of the year? What would be the post-acquisition profit up to the beginning of the year? Up to the beginning of the year, what would be the post-acquisition profit? $1,300 minus 1020. I'm having 280. This 280, MCA will have 25% of it. So NCA will have 70 from November 2014 to 1st October 2016. But when are we disposing this? We are disposing this at 1st July 2017. That is 9 months after operation. So it means that we are going to find 9 months of their profits in the statement of financial position. What is the 9 months of their profits? The UV. What is the 9 months of their reserves? 9 months of their reserves. Their total reserve is 709. So we find 9 months of it. So 9/12 times 709. I'm getting 531.75. So this one, we say we should approximate it to this one, so we make it 532. This 532, NCA will have 25% of it, so 0.25. I'm getting 133. So the NCA figure will now be, or if you like, what you also do is that you pick the one at acquisition, which is 1020, Then you now find the profit as profit up to the date of what? Disposal. So you have 532 plus the 1300. That will be the results up to the date of disposal. You subtract the 1020 from it, then you add, you multiply it by the NCR figure times 0.25. You are going to get 203, which is the same as the 70 plus 133. So you have 203 plus 280. That will give you the NCR figure. So NCR will be 483. Okay. The question now is, what would be their net assets? What would be their net assets? What would be their net assets as at the date of disposal? It will be the share capital, which will not change, which will be 100, which will be 100, plus the reserves up to this date. So the reserves will now be the profit for the profit at the beginning, the reserves at the beginning, which is 1,300. Reserves at the beginning, which is 1,300, plus 9 months profits, because they have done 9 months before we dispose it. So 9 times their profits, which is 709. 709. So that will be the reserves as at the date of disposal. So 9/12 times 709. 532. So 532 plus 1,300. That will give us 1832. Then since we are selling, we sell together with the goodwill. So goodwill must also go. So the goodwill has not impaired. Since the goodwill has not impaired, it means that the goodwill will go with the 140. So let's now total this. So we have 100 plus 1832 plus 140. So I'm having 2072. Then I'll go and compare it with this one, what I'll be having here. So let me just put this together. So I will subtract this from that. This minus this. So I'm having a gain of profit on disposal. Profit on disposal of 163. This will be shown as a line item in the parent statement of profit or loss. So we can add it to the investment income if you like, but it should be shown as a line item. But since we don't have anything concerning that, okay, let me just show it as a line item here. Profit or profit on disposal of UV. And that will give us 163. Okay. That is relating to that particular part. That is all about it. Before you find a gain, you first have to know the goodwill, because they will sell the company together with the goodwill. But you have to know your net asset at the date of acquisition. You have to know the net asset, the total net asset. What portion is relating to the NCI? So you have to find the NCI value at the date of the disposal. How can you find the NCI value? You find the NCI value at acquisition, then you take the share, the post-acquisition profit up to the date of disposal and find the NCI share. You add it to the NCI at acquisition. That is a portion. That is how we go about it. So we are done with the first part. We are done with the first part, and we are now coming to deal with the second part. But what will happen is that for the remaining 3 months, the company is going to account for the UV as associate. So let's go to share of associate profits. So share of associate profits. Share of associate. Share of associate profits. So they are going to account for this as share of associate profit for 3 months. And they are going to multiply this by 35%. So we pick 35% or 0.35 multiplied by the 3 months profits. The 3 month profits. So we go and pick the profit of UV in the statement of financial position. So profit for the year is 684. So 684. So we multiply this by 684 multiplied by 3/12 because we consolidate them for 9 months and we are going to have them as an associate for the remaining 3 months. So 3/12 multiplied by 684 times 0.35. 60. I'm having 60. So if you come to the other comprehensive income, we are also going to have 3 months share of their actuarial gain. They are also going to have 3 months share of their actuarial gain and also 3 months share of their tax effects. So we are going to have 0.35 multiplied by 3/12 because we consolidate them for 3/12 and multiply by 40. Okay. Then since we are sharing all of this, we have to share the tax effect too. We have share of the tax effect too, because we should have share 25, but we are sharing that. So we multiply this also by 0.35 multiplied by 15. Okay, this will not be multiplication, it will be plus. So this will be plus multiplied by 15 times 9/12. Okay. So for this one, we are done with that particular one. We are done with A, we are done with B, and we are done with C. Let's go to D. Let's go to D. BP paid a dividend of 100 on 1st October, and SOT has recorded each share in investment income. So the dividend was paid on 1st September 2017, and the parent has taken each share to investment income. So the share, what will be the parent share? The parent share will be the percentage that they are having in the BP. That will give you 80%. So they are going to have 80% of the 100,000. So they will calculate 80% on 100,000. So 0.8 times 100. And they are going to have 80. Let's look at and see whether, okay, so the investment income is the 80. You can't show this in the profit or loss because you are already going to take the share of the subsidiaries profits. You are going to share the profit over here. So the investment income will not come here. So what we do is that we now come and cancel the investment income because this is already included in the profit before we share. So we cancel the investment income there. That is all about that particular one. SOT holds several investments held as fair value through other comprehensive income and account for this in accordance with IFRS 9 financial instruments. Gains on subsequent measurements of 46,000 occurred in the year. The financial controller, however, is unsure how this should be presented within the statement of comprehensive income, and so has yet to include it. So this is investment through other comprehensive income. So when there is a fair value gain on it, what we do is that we send it to other comprehensive income. So this 46,000 over there will be shown as fair value gain in other comprehensive income. Let's come and show that instruments classified through other comprehensive income. So we see fair value gain, fair value gain, fair value gain, which is 46,000. 46,000. So we are done with that one. Okay. SOT also dispose of investment held as fair value to other comprehensive income debt instrument during the year to 30th September 2017 for 630, when the carrying value of the investment was 580. The gain on disposal of 50,000 is included in administrative expenses. Previous recognized gains associated with this investment of 40,000 still remain in other reserves. So if you dispose of financial assets, which is through debts, if the financial asset is a debt instrument, when you dispose it, you reclassify all the previous gains that you have sent to other reserve to statement of profit or return earnings. So what we'll do is that we are going to reclassify the 40,000 now to other comprehensive income. But the gain on it, okay, they are already in other comprehensive income. So we reclassify all of them to statement of profit or loss. We reclassify all of them to statement of profit or loss. But a gain, which is 50,000, should have been recognized as a gain or profit on disposal of the instrument. But what they did is that they have included this in administrative expenses. This means that this is an income. So what they do in the administrative expenses is that they have subtracted it because it's an income, and this administrative expense is a cost. So they are going to net this against the administrative expenses. But they shouldn't have done that in the first place. So we are going to cancel this. Canceling this means that we have to come and add back the 50. So we add back the 50. Then we now have again fair value gain, or we can name it reclassification. So let's do reclassification here. Item reclassified to gains reclassified to profit or loss because they have been disposed. So we reclassify them to profit or loss. So we have over here we have the 40,000 plus the 50, which is the gain which was credited to administrative expenses. That is that one. And apart from that, we are done. That is all. All right. So we have done this already. 40. We have done this one. We have done this. So what we do is that we just total this. It's plenty. We can't total. So income, we total. Then this one too, we total. So you find all of them and total them. Then you find your gross profits, and you also total this. This cost, you also total it. And you have share of associate profit. We have done that already. Disposal, we have done that already. The reclassification will be 90. Investment income will be 0. Then finance cost, we total it and bring the figure there. I want to talk about how you are going to share the profits among these people. So the profit that we are going to share, profits attributable to parent holding. So how we are going to share the profits between the parent holding and the NCI. Okay. Hello? Yo, man. Yeah. They unlock the gate. I wonder. So you come before you call me, or I know this number I no save am for my small print up, so I wonder they can open. Okay. So let's see. You can, if you have time, you can add that. So let's see how we are going to share the profit among these people. The profit will be shared. The first one, which is the profit for the year, the 840, which is for BP. The BP people, their shareholders will be taking 20% multiplied by 20% multiplied by into brackets. Then their profit, which will be, they are going to have only 5 months because we consolidate for only 5 months. So we are going to have 5/12 multiplied by the profits. But this profit, what will happen? There is one post-acquisition adjustment, which is a depreciation of 10. The depreciation of 10. I'm sure it's the depreciation of 10. Okay, depreciation of 10. So we find 5 months of this, 5 months of that, then we subtract 10 from it. That would be this one. If the goodwill should be a full goodwill, because they are using proportionate method, so it's only the parent that is going to suffer the impairment loss. So if it should be a fair value, it means that the goodwill will be shared. So we take the goodwill from this one. So what we do is we just take 5 months of the profits, because we consolidate the account for only 5 months. Then we take the post-acquisition depreciation from it. Then that is all. Then the NCI will be 2 plus this one plus the share for, and the share for the UV NCI people. We consolidate the account for 9 months. So what we do is that we find this thing is 0.25% multiplied by 9 months of the profits. 9/12 times their profit for the year. Times their profit for the year, which is 684. 684. 684. So that is it. If you come to other comprehensive income, then you also share that. It's already 9, and I'm already tired. Complex groups, we solve it during the intervention. We solve question on the complex group during intervention. We are done with the disposal, and if this question should come in the exam, it will worry small, but don't worry.
Let's go.
If you ever find, this is a question that you can get on disposal, and this is how it will be. So you have to ask yourself whether you should, the one that you are selling, whether you are going to consolidate for some months. Are you having control over them for some months before selling them? You consolidate them for the months that you have control over them. All right. So this is all. If you have time, you can add them one by one. Okay. If you have time, you can add them one by one. 46. But I'll put them together and send you the final figure. All right. If we don't have any question, I want us to end over here. We meet on Wednesday. That's small. Emmanuel, EQ, do you have any question? You can try that question on yourself. I have solved everything already. So you just add the figures, or you can still ask yourself, you want to try it on your own and see. That's small. Any question?
No, I'm okay.
Emmanuel, EQ, Eugenia.
Oh, I'm okay.
Olivia. Mami AC. Okay. If there is no this thing. Okay. All right. So putting the figures is almost 9. Putting these figures together, it will be some way. So that is it. That is all about the step acquisition and disposal. This disposal, you can even have some intra-group transactions here. You bring it over here, you adjust it over here. But this question is already involved. The question is too plenty. So if they should add those cells and those things to it, to worry. All right. So if I have time, you can put some of these items together. You can 5/12 times this plus this over this. You can put them together. You find your gross profit. You find your profit for the year. Then you can try and see whether you can share it among them. But that is the sharing that I have done. That is all. So complex groups, we solve questions on it on Wednesday. Maybe one question on it, and that is the end. If I want to start right now, it will be like 11 o'clock, and we are already exhausted. People are writing 5 papers, people are writing 4. It's not easy. I'll see you when you see me. Thank you for coming.